this video in particular, we're learning about fair value gaps. There's three types of fair value gaps. We're going to be going over two of them in this video, bearish and bullish fair value gaps. There's also one called an inverse fair value gap, but that will be going over and covered in the next video, so don't worry about that. This one we're just strictly focusing on bearish and bullish fair value gaps. What is a fair value gap, you may ask? It's an imbalance in price action that causes a gap between three candles. Well, a gap between two candles, but it takes three candles to make it up. In simple terms, you have a bullish candle with a wick, and then a bigger bullish candle that has a gap, and then a third candle that has a wick that doesn't touch the gap of, or the wick of the first candle. To draw it out, you can go like this: candle 1, wick, wick, candle 2, and then candle 3, wick, wick. So this big void gap right here is a fair value gap. It's an imbalance in orders, meaning that there's a lot of buyers right here, and that is why it created a gap, because the amount of buyers completely overthrew the amount of sellers in the market, creating the fair value gap. So this would be a bullish fair value gap. Delete that. All right, so now we'll go over what a bearish fair value gap looks like. It's the same thing. We have our candle, wick, and then we have our second candle, and then our third candle with our wick right here. And this big void again, an imbalance this time, since it's a bearish fair value gap, an imbalance of sellers. So that means that there is a lot of sellers in the market that are overpowering the buyers, causing this bearish gap. So this is going to be a bearish fair value gap. Let's go and mark it out on the actual charts to see what they really look like. As you chart these out, mark them out over and over again, they become kind of like a secondhand nature to see on the charts. So right here we see, let's go to a better time frame. You can see these on all time frames, so it doesn't really matter. We have a bearish fair value gap right here because we have our bearish candle, we have our wick, we have our gap right here, and then we have our other wick right here. So this makes a bullish fair value gap. I mark my bullish fair value gaps as purple. It's good to be coordinated, or color coordinated with your confluences, so you know what is what without having to input all the different letters and stuff on the charts. So I use my bearish fair value gaps as purple, and my bullish fair value gaps as blue, or as yellow, sorry. So any given bullish confluence I will mark out as yellow, any bearish confluence I will mark out as purple. Right here again, we have our, let me go to the brush so I can mark this out. We have our wick right here. We have our gap and our other wick. So this makes a bullish fair value gap. On higher time frames like the 15-minute, 5-minute, and 1 hour, those tend to have stronger confluence and stronger backing. When it comes down to it and we're looking for actual entries, we go down to the 1 minute and mark out fair value gaps, confluences like that. But we can use the 5-minute, 15-minute, 3-minute to also mark them out for zones. Let's see where we can find an example of where a fair value gap is respected. Let's go to Friday that just passed, since it's Saturday today. Friday. So we have market open right here. Where was I? Market opens right here, and we see this bullish fair value gap right here. Mark it as yellow. And we can see price doesn't really do a good job at closing below this fair value gap, and that's why it gets respected and bounces off of it. Another good example would be right here on the 5 minutes. We have another fair value gap right here. It's kind of hard to see because this wick is so tiny right here. But we have a bullish fair value gap. Why, you may ask? Because we see our wick right here, our candle right here, our big void of buyers that are overpowering sellers, and then we have our other wick right here that's super freaking tiny, but it's still a wick. So right here we see a bullish fair value gap, and we see that price fails to close below this fair value gap, so that's why it is respected. And then we see price also breaks into this fair value gap again at 10 a.m. on Friday and respects it and rejects off of it essentially. So that's what you'll be looking for when it comes to bullish fair value gaps. Go down to the 1 minute and let's do this. We have, this is a good example. We have New York session right here, morning session, from true open at 9:30 till 11. That's when I normally trade, is between 9:30 and 11. If I don't see any trades between that time, I don't trade for the day. I've just learned that off of discipline, and that's what the model and rules that I follow. So right here, we'll see price is moving up. We have not only one fair value gap right here, like that. We have another small one right here. I don't really ever consider trading off of these tiny fair value gaps just because they hold such little confluence in the market. But then we also have another fair value gap right here, which price is respecting. Another bullish fair value gap. We see the buyers fill this up. We have our gap. We have a retracement back into this fair value gap that gets respected. So we then shoot back up into bullish price action. And then right here, we see a higher high, a higher high be made, a lower high be made, a higher high be made. And then we see a lower low made, and then a lower high. And then once again, a lower low. We see break a structure right here. I'm going off on a tangent, but just to show you this. And this turns the market from bullish price action to bearish price action. And then we see the close below right here on this bullish fair value gap. So that then gets invalidated. And we see, oh, what is this? A bearish fair value gap right here. We see our wick, our gap, or another wick. So we'll mark this out as our bearish fair value gap now. And we see price then comes back into that fair value gap, fails to close above it, so that respects it, means it has good confluence behind it, and rejects off of it. So that's really all a fair value gap is. There's no need to overcomplicate these confluences. I want to keep it as simple and as easy to understand as possible for you guys. Again, we have another bullish fair value gap right here, and then another fair value gap right here. When you're on the 1 minute time frame, you'll see them line up back to back to back like that, just because of how price moves on the 1 minute time frame. But let's say we go to a higher time frame of this same area, like the 3-minute or the 5-minute. We'll see now that, hey, it would be also a bullish fair value gap. Why? Because we have our wick right here, our big void right here, and then our other wick up here. Simple as that. Fair value gap is a void in the price action causing the imbalance. And we see right here, we make this fair value gap, price then retracts back into it to fill that imbalance, and then rejects off of it because it fails to close below it and makes a new higher high. So really, when I'm marking these out, I like to really trade off of the 3-minute and the 5-minute, but I will execute on the 1-minute to get better entries and exits. And always I'm targeting liquidity. So really what I want you to do, after you watch this video, you can go on to the next one, or you can go onto the charts, take 20-30 minutes and just mark out fair value gaps. It makes it a lot easier for your eyes to see them. Like right here, another bullish fair value gap, price respects it, bounces up, and then right here, once it closes below it, that is what invalidates the fair value gap. Right here, we then have, let's see if we can find a bearish fair value gap. Right here, we have a big bearish fair value gap on the 3-minute. So more than likely when market opens on Monday, we'll see some sort of retracement up into here, or we'll just see price continue to fall because right now we're in bearish price action. Right here, we have a bullish fair value gap. Why? Same again. We have our candle with the wick. We have our big imbalance causing the big imbalance is that there is a vast majority of buyers right here rather than sellers. And then we have our other wick right here that makes the fair value gap. If you turn on the volume right here, you can see that when this candle was formed, there is more buyers than sellers. So that's why there is that gap right there because of the imbalance. But always when an imbalance is created in the market, price does have to retrace back to the imbalance to fill out orders properly. So that's kind of where we find our entries, is when the imbalance gets respected. So let's just go over more on how to see fair value gaps. Right here, we have a bullish fair value gap. Even though this is a bearish candle, it doesn't matter about the color, it just matters about the wick. We see our wick, we see our gap, and we see the other wick. Bam. Bullish fair value gap, gets respected, price moves higher. Another example of a bullish fair value gap right here. We have our candle, we have our gap, we have our wicks. Bam. Price moves up, fills the imbalance, fails to close below it, and makes higher highs. Let's look for a bearish example, just because we've been doing a lot of bullish examples. Let's get off all of these other nonsense stuff so it doesn't confuse you. This is just trades I took throughout the week. Let's look for a bearish example. So right here, we have a wick, a gap, a wick. What does that make? A fair value gap. And this one's going to be bearish because we have bearish price action right here. So we see it, goes down, fills this imbalance right here by tapping into this fair value gap. It fails to close below it, or fails to close above it. So that's what makes it respected. And we make a lower lows. And still again, we're filling up this imbalance. We see price retrace back up into here, which is this same fair value gap, which is respected. So we tap into it and then make a lower low because we're respecting this fair value gap. What we can see between this fair value gap and this imbalance are also bullish fair value gaps. Like we have one right here, which doesn't get held. It gets invalidated pretty quickly. And then we also have one right here, which gets respected and allows us to get back up into this range of our bearish fair value gap, but this holds strong confluence, so that's why we reject off of it. Let's see if we can find another example of a bearish fair value gap. One right here. We have our wick, our body, and then our wick. Makes us a bearish fair value gap. So we see the imbalance because of the gap right here. We see our two wicks. That's what makes our fair value gap. We see price then go down, retrace back into our fair value gap, and then bounce off of it because it is respected and not invalidated. So when we come back into the zone, this is pretty much hunting the imbalance so that price can move properly. If imbalances never get filled out, then we would always just be going down or always just be going up, and we wouldn't be able, market just wouldn't make sense. So we have the imbalance right here, the gap, the fair value gap, and it gets respected. That's why we make our new lower low. But then here we see another bearish fair value gap right here, but we also see a bullish fair value gap right here. This would be considered a inverse fair value gap, since we had our bullish one or our bearish one right before it, and this bullish one invalidates that. I'll go over that in the next video, because that's the video that I'm going to be covering inverse fair value gaps. But we see price invalidates the bearish fair value gap, making our bullish fair value gap a inverse fair value gap. A lot of it's like a tongue twister saying fair value gap so many times. But when it invalidates this bearish fair value gap, that makes this bullish fair value gap a bullish inverse fair value gap, and that's why price respected it and bounces off and actually goes to invalidate this initial fair value gap. So yeah, it's a pretty simple confluence. It's just gaps between candles. And those gaps between those candles are where orders would be placed, and that's where the imbalances get filled, are at those gaps. More examples, we have another bearish fair value gap right here. Why? Because we have our wick, our gap, our wick. Right here again, we have our wick, our gap, our wick. And we see price. We see this bullish fair value gap get formed, or sorry, our bearish fair value gap get formed right here. And then we see, what does price do? It retraces back into it to fill out that imbalance. And then bam, it fails to close above it. So that means that the fair value gap is being respected. And that's why we continue lower like so. More fair value gaps. I see them clear as day because I've been doing this so long. We have a bullish one right here. We have another bullish one right here. And the more you mark these out, this one gets invalidated pretty quick. So you wouldn't trade off of this bullish fair value gap because it gets invalidated. But as you mark these out, they become more secondhand nature to see in the market while you're trading. So all I could recommend is, after watching this video, you can either take 20-30 minutes out of your day before you continue on to the next one, or you can continue on to the next one, learn about inverse fair value gaps, and then after you watch those two, go onto your chart and start marking them out. What I did for a long time was, I would just, after I was done trading and I was back testing, or not even just back testing, just marking out confluences, so my eyes became more keen to seeing them, Just go back and mark out every confluence that you see. Like, bam, fair value gap. Bam, fair value gap. Bam, fair value gap. Now, look at all these bullish ones get invalidated because we see these closes below them. Let's go to the 15-minute, make it a little easier to see these as well. The higher time frame you go to, the stronger the confluence will hold, just because of the amount of orders that it took to make that confluence. Like right here, big bullish fair value gap. We see not only once does it hold, not twice, not 3 times, but 4 times it gets held before it is invalidated on the 5th retest. Some people don't even trade on the lower time frames. Some people will only trade off of the 15-minute time frame, or the 1 hour, or the 4 hour. That's not how I do it. That's not how I'm going to teach you how to do it. But if you're going off and going to go watch other YouTube videos about it, so be it. I'm not going to stop you, but I'm going to give you what I know and what I know works to help make you profitable. So yeah, we have this fair value gap that gets respected all those times. That's a big bullish fair value gap. Let me see if I can find a bearish one in here. It's tiny one right here. Wouldn't really you can mark that, but it's really tiny, so you don't have to. But then right here, we see this bearish fair value gap. Why is it a bearish one? Because we have bearish price action. We have a bearish candle that creates this big gap. And we see price fails to close above it, and that's why it is respected until it gets retested on the 3rd time. Then it gets invalidated, and we see price goes from bearish to bullish. But we see right here the wick, the big candle of sell orders overpowering buy orders, causing the imbalance, making it a bearish fair value gap. And we see price goes down, retraces back into it, fails to close above it, so it respects it, and we see we make a way lower low. So that's really going to be it for fair value gaps. What I'll say is actually watch the next video before you go out and mark these, or you can go out and watch all the videos before you start back testing these confluences, which I would not recommend at all, because there's like, I think what, like 10 different modules. Let me see. 1 2 3 4 5 6 7 8 9 10. There's 10 different videos, which is gonna add up to probably over an hour to maybe 3 hours worth of watch time. I don't know yet because I didn't record all of them. Record them as I go. So I would recommend, don't try to learn this so fast that you don't comprehend what you're actually watching and learning. Do it piece by piece. So right now we're watching the fair value gap video. Watch the inverse fair value gap video next. Learn those two confluences in depth. Really pay attention and learn them. And then go onto your chart and start learning how to see them in the market and see how they're respected. And what I mean by that is just go to your chart and just start marking them out. Like these white lines I have up here, those are levels of liquidity. I'll go over that in the video that's called levels of liquidity. And that's where price goes to after, as it's filling out these imbalances, it seeks out levels of liquidity. I'll go over that more in depth, but like, it's so like once you just start doing them and marking them out, bam, fair value gap, bam, fair value gap, tiny fair value gap right here. These are all bullish fair value gaps. I'm just doing them quick to show you that once you start doing this for so long, it just becomes secondhand nature. We see price consolidating right here. Why? Because right above this bullish fair value gap, what is there? A bearish fair value gap right here. So we see price respects this bearish one. and respects this bullish one, but then bam, what happens? We close above this bearish fair value gap, which invalidates it. So we'll just go ahead and delete that after. But then what happens after it invalidates that? Oh, look at that. Another bullish fair value gap gets formed right here. Like, it's as simple as that. Just learn it, do it over and over and over and over and over again. It will like literally brainwash yourself or brainwash your eyes to just see this. It's no other way to put it. The more you mark these out, the easier it will be for you to see this. Like, bam, right here, another fair value gap. It's hard for me not to see nowadays because I've been doing this for so long. But yeah, like even on the 1 hour, we'll see these fair value gaps as well. Like on every time frame, you'll see the confluences I'm gonna teach you. Like look at this fair value gap, price, then jumps back into it to fill the imbalance, and then jumps way lower. What happens again after that? Another bearish fair value gap gets formed right after. It goes into it a little bit, goes down, retouches it again, and then makes a way lower low. What happens when it makes that way lower low? It makes another fair value gap right here. Like, it's insane. Like, goes down, retouches back into it to fill the imbalance, fails to close above it. What does that mean? That it's being respected. So that now we have a prominent 1 hour bearish fair value gap. And what do we see when it gets respected? Oh my god, who would have guessed? Another fair value gap that is formed right here. I mean, this gets invalidated once we see this close above here, but it still respects the initial fair value gap that formed before it. And what do we see when it's filling this imbalance? More fair value gaps within it. Like it's secondhand nature once you do it for so long. Like look at that, another fair value gap. Fair value gap. I mean, this one gets invalidated right here, but then we make this fair value gap right there. Like they're all over the charts. Just go and mark them out. Brainwash yourself to see what a fair value gap is. Like look at this. Fair value gap. It's such a simple confluence, and people just don't understand like how easy it really is to learn these things, and they just mix themselves up by watching the wrong videos or learning the wrong things or being taught the wrong things. And that's what I'm here to do, is to teach you the right things. And that's why I have this set playlist to teach you these confluences properly so you can trade off of them and start making money. Like look at this fair value gap right here. Like they're all over the place. Fair value gap, fair value gap, fair value gap. It's so simple. Like we have it's I don't even know how to make it sound complicated because it's not. We have our candle, we have our wick, we have our imbalance of orders, and then we have our second. What the heck just happened? Where 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 the heck am I? Where did my drawing go? Where the heck did my drawing go? Alright, we'll restart it. We have our candle. We have our wick. We have our other candle. Make this a little longer, actually. And then we have... Dude, what the heck? We have our candle. We have our wick. We have our imbalance of orders. And then we have our other candle with the wick. Fair value gap. This imbalance. Fair value gap. Same thing on the downside. Candle. Wick. Imbalance. Candle. Wick. Fair value gap. Go into your chart and just mark this stuff out over and over and over again, and it becomes secondhand nature to see this confluence. Like they're all over the place. There's no other way to put it. So that's going to be the video on fair value gaps.